Hi there, welcome to Kneppy Invest. The other day, as I was scrolling through a social media platform, I won't mention which one, and I am apt to do that on occasion, I came across the comment that's named EZZ Life Sciences, the company I'll be focusing on today's video, as the cheapest company on the ASX. They were fairly definitive about it. They didn't mention that EZZ was profitable. That's just my own words. So the question I have for you is EZZ Life Sciences the cheapest profitable company on the ASX? I am not going to answer that. I'm going to leave it to you. I'll give you some evidence for and maybe against that comment, but there are some compelling arguments to suggest this is a fairly cheap company. But whether it is the cheapest company on the ASX, you'd probably have to know all 2,200 companies on the ASX quite intimately to actually be fairly confident in answering that question. So, who is EZZ Life Sciences and what exactly do they do? Usually, when I'm unsure what a company actually does, I either look at a presentation the company has released and or I go to the company's website and just look at their about section. Most companies do have an about on their website, and if you click on their about, the company will talk about themselves. So how does EZZ Life Cycle or Life Science describe themselves as? Well, they call themselves a genomic life science company with a mission to improve quality of life and human health. They are focused on genomic research and development to address four key human health challenges. Two of those are genetic longevity and weight management. The other two I'm not going to try to pronounce. One of them is HPV, and the other one I have no idea how to pronounce it, so I'm not going to even try. They do have products through two sort of divisions: the EZZ subsidiary or division, and the Eron division. And the EZZ is all about health supplements, and the Eron is about skincare products, selling to pharmacies, supermarkets, and specialty retailers. To be honest with you, I've never seen any of these, although I'm probably not the market. For instance, coffee jelly, I just don't drink coffee, and I have no interest in anything else here. Immunity Plus, acid collagen, hydrating face masks, that is something I would not use, and whitening capsules, daily youth restoring serum. So I have no interest really in any of these products. The question is, does the rest of the world have any interest in these products? Well, that's the whole point in researching a company, to see what their market is like and whether these products are actually any good. EZZ is a fairly young company, founded in 2018 and listed on the ASX on the 3rd of March 2021. So actually, they've been listed on the ASX for about 14 months. The CEO and largest shareholder is Mark Jin. I have no idea how to pronounce that. He has a 26.5% holding in this company, so fairly good skin in the game. Probably suggests maybe he also could be a founder of the company as well. Now we get into whether this company is cheap or even the cheapest company on the ASX. The current market cap of EZZ is $15 million. That's a share price of 35 cents. Now, in isolation, that tells us nothing. There's a lot of companies with a market cap actually significantly lower than that. The question is, because they are profitable, how profitable are they? There's another question we have to ask ourselves as well. How much cash and debt do they have on hand? Because that is actually fairly important. And you'll understand that when we look at their cash balance later in this video. And the ticker for this company could be anything else but EZZ. Now let's have a look at the financial state of this company. And we're going to compare the half-year numbers for this financial year to the half-year numbers 1 year ago. And this is where we do see some potential problems with the company, because when you look at the revenue, it actually dropped from 12.6 million to 6.2 million. So the first question I'd probably have, if I want to do any more research on this company, is why did we see a significant drop in revenue from last year? Gross margins also fell, and even though we did see a significant drop in revenue, the company is still operating cash flow positive, only by 300,000, but it's still positive, and they're profitable by $100,000, which is a bit of a drop from last year. They're actually profitable by 1.2 million. So the company is bringing in cash in their business, and they are profitable, but it's on the fairly low side. But because they did or were profitable by 1.2 million last year and were operating cash flow positive $700,000 last year, doesn't mean they can't get back up there if revenue, instead of dropping by half, actually rises by half. They also have $10.4 million of net cash. So remember, I said that's very important because you have to take cash into hand when you are evaluating, or not evaluating, when you are valuating a company. So that means the enterprise value, which does take into account cash and debt, is only $4.6 million. And this company, again, is profitable and producing cash in operation. So there is the argument with an enterprise value of only $4.6 million, this company could be cheap. The only concern here is the significant drop in revenue this company experienced in the past year. EV to operating cash flow, 15.3. Now, in isolation, that would not lead to me calling this company cheap. But again, the operating cash flow is on a low base. All they have to do is triple that, which would not be hard, going from 300,000 to 900,000, and that would make this company cheap based off the EV operating cash flow, which would make that about 5. Now, before we have a look, and the whole motivation or motivating force for me doing this video was the release of their March quarter Appendix 4C for the financial year 22. So before we have a look at that, I just want to go back in time, have a look at the March quarter for financial year 21, and this would actually be the very first Appendix 4C this company did release, and I would have actually seen that, this particular release, and probably not really have taken notice to it all that much because they were operating cash flow negative by 1.1 million, and this was their first quarter. I like to see a few quarters of history before I really start looking at a company in depth. So one quarter in isolation tells us nothing. And because this was just after they IPO'd and they raised $6 million in the IPO process, the cash on hand increased from 3.8 million and finished at 8.3 million at the end of this particular quarter. Now let's see how business has performed for EZZ or EZZ. Maybe it's EZZ or EZZ. I don't know. Anyway, let's see how things have performed for this company over the past year. We've already mentioned that receipts or revenue have dropped over the past year, and that's definitely true for receipts as well. Comparing last March quarter to this March quarter, receipts were actually down 1.1 million. But they also saw a significant drop in advertising and marketing costs, down 1.6 million to only 304,000. So spending much less on advertising and marketing their products. That actually can be a bad thing. Staff administration costs up 100,000. Product manufacturing and operating costs down 1.4 million. Because they saw significant decreases in some of their spending, advertising, marketing, product manufacturing, and operating costs together down $3 million, even though receipts were down 1.1 million. This company went from being operating cash flow negative last March quarter to being operating cash flow positive by $1.5 million in this particular quarter. And because most of that money fell to the bottom line, so they don't spend much money on financing and investing activities, that meant the cash on hand in this business grew from 8.9 million to 10.4 million. So we do have 5 quarters of history right now for EZZ. I prefer to have at least 8 quarters before I determine whether there's any trend in the company's receipts. I do want to see receipts or even revenue growing through time for any company I am thinking of investing in. For EZZ, it started off pretty badly because receipts fell from $5.1 million in the first quarter down to 3.6 million in the September quarter last year. But there is potential. Things are turning around for this company because we have seen receipts grow over the past 2 quarters, up from 3.6 million to $4 million in the most recent March quarter. Now let's have a look at the EZZ chart, going back to when they listed on the ASX back in March 2021. And a fairly exciting story for the first few days of trading. Share price did reach a high of $1.40 or so on the second day of trading. Fair bit of volume too over the first 3 days. So there was a lot of excitement in this company during those first week of trading. However, that hype died away, just like many other IPOs, and share price has consistently fallen since then. In fact, the share price has fallen from that high of about $1.40 all the way to a low right now around about 30 cents or just below 30 cents. And on the last day of trading for the week, on the 27th of May, share price of EZZ dropped 15%. So not a lot of liquidity in the trading of these shares, I don't think there's not high volume as well. Now, there are a few things to be concerned with EZZ, apart from the share price looking pretty bad here, the chart looking pretty bad here. And the reason they became operating cash flow positive in this particular March quarter was because they reduced cost. I prefer a company become operating cash flow positive because they're growing receipts at a greater rate than they're growing costs. You can't really say that with EZZ right now. Now, I'd want to wait at least 3 quarters just to see if they can continue this momentum over the last few quarters with a growth in receipts, just to see if this is just not a one-off or two-off with these increase in receipts. So I'd like to see some traction in their sales, and it is concerning that they need to spend significantly less in advertising and marketing and significantly less in product manufacturing operating costs, which suggests they are not producing as much products. Now to the question whether EZZ is the cheapest profitable company on the ASX. I'll leave that up to you to decide. I'm not going to say it is or isn't because I don't know all 2,200 companies on the ASX intimately. But just looking at some metrics, there is a possibility this company is quite cheap. Enterprise value less than 5 million, and they are profitable. They are producing cash in their operations. And if they can gain traction in the selling of some of their products and they can increase their profitability by 4-fold in 1 year, which they could easily do, this company would seem really cheap at this point in time. So what I might do is I'll just leave this on my watch list. And if I do see a breakout in the share price on the back of some really good financial news, that could be the time to take a position in this company. That's just talking about my own strategy. You could have a different strategy. If you think this is really cheap right now and the cheapest profitable company on the ASX, maybe now is a time to take a position in EZZ Life Sciences. That's all I have for this video. Last thing I should mention is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.